In today's video, we're going to talk about Sofi Technologies, trading under the ticker symbol SOFI. Now, before the video begins, just a quick reminder or a heads up that not all my videos are made on the same day they're posted, and if there are material events that happen afterwards, I'm going to make a follow-up video to reflect those changes. With that being said, let's go on to today's video. Sofi Technologies operates in financial services sector. It provides the services of loans, refinancing, and credit cards, and also wealth management solutions. It's a company based online and separates itself from the competition by the fact that it doesn't really operate in the physical environment. So its appeal is the massive user base subscribed to its platforms, which may consist of a large pool of potential clients, which may contribute to the fast growth of its revenue amount and the number of revenue streams. Sofi also benefits from the presence of famous investors who are almost perceived as superstars in this day and age. And the fact that after years of discussions and speculations about what we would like to call a lightweight bank, because it is now mature enough to get deployed to the public at large. Looking at Sofi as a company and a potential entity to invest into, I think that the biggest portion of the market correction may be behind us. Looking at Sofi as a company and as a potential entity to invest into, I thought that the biggest portion of the market correction was behind us right before this current wave has begun. And not just to Sofi, but also to a whole bunch of other growth type companies. So Sofi, how can I put this? It's actually a miracle, in my personal opinion, that it manages to gather so much upward momentum. Because it's a fintech company, and fintech, frankly, doesn't always have the benefit of doubt from the market. And it doesn't always benefit from that kind of patience from shareholders. It may have been the case years ago, but it's been a while since the market may go wild for a company that operates in that sector. It's definitely one of the few fintech companies that manages to maintain a decent valuation and stock price in time, in a relatively long period of time, and in an overall environment where valuations have been very high in the first place and are having tremendous downward pressures from the gravity of, I would just like to call, reality. At some point, people are holding stocks. They're going to realize that it's based on a narrative and not necessarily on a valuation. And I'm not saying this necessarily by insinuating that it's a bad thing, but it's just part of our reality as how the business is currently operating, or at least how a significant portion of NASDAQ is operating. It's just part of the fact. So if we look at other companies like PaySafe, for instance, Sofi is doing a much better job than PaySafe in terms of maintaining its narrative, in terms of giving people enough hope, and in terms of giving the market something to push the stock price higher. That has been the case during I would say the last few months of 2021. And even then, it already had a lot of pullbacks, but it doesn't mean that the stock was finished. And it still doesn't mean that. All I'm saying is back then, we thought that as soon as the company has the bank charter, then it's going to take off. Now, a few months down the line, I think that it's going to be a little bit more complicated than this. And we should really have an honest conversation with ourselves in regarding to, one, should we be owning this share? Two, if we want to own it, how much should we be owning? And three, if we want to own and with a pre-allocated amount, is now the time to buy it? So first of all, I want to say that it's usually in moments like those that you want to start looking for entry points when the price suddenly goes down and without any significant reasons. Like the next financial data release date, maybe it's going to create some volatility in the market, but that's a little bit too far for me to start considering this as a possible reason, or at least as the main reason. I think that the main reason why the stock began to fall is because the whole market or the whole sector began to be sold by investors. The domino effect maybe somewhere else, or actually, it's probably somewhere else. To give you an idea, I remember that back in 2021, I think that the first piece of domino to fall was Lucid shares. So Lucid Motors at the time was in the high 50s or maybe in the 60s. And then all of a sudden, the deal came out and people realized that the private shareholders have a much better deal than the public shareholders of CCIV. Then the whole thing just started to unravel by itself. I think that this time something similar happened, and as a result, the entire sector was dumped by both retail and institutional shareholders. Actually, I think it's mostly by retail shareholders. Institutional shareholders, they tend to stay in companies as time goes on. I'm not sure that's always going to be the case with the retail shareholders. So my first reaction would be, okay, now that the volatility is negative, let's try to go in and to lower the cost basis. But my second one is, we usually know that the bottom is reached when the bottom is no longer there. When we've moved beyond the bottom, now that we're like higher than the bottom price. And for me, that's okay, because at least I would have a confirmation that the downward trend is over. I don't see this confirmation just yet. I may see a slight inflection of the downward pressure, but I'm not seeing any sort of signal from the market saying that this sell-off is now over. As soon as I see this, I would increase my total Sofi ownership. Right now, I have about 0.1 or 0.3% of my portfolio in Sofi. I would probably increase it to 0.5 to 1% of my portfolio when I have this confirmation. Some of you may be wondering, yeah, but I mean, isn't this a very low percentage of ownership? For me, this is how much I'm willing to risk with Sofi at the current period of time. There are persistent rumors that as time goes on, especially in 2022, many central banks may be increasing their interest rate. So if that's the case, then there will be money flowing from the equity market to the bonds market. And that's not going to be a necessarily good news for growth type companies. Because growth type companies, historically, especially I remember conversations way back in like 2013 to 2014, saying that the reason why in Silicon Valley people pour money into startups is because there's so much money flowing around, thanks to QEs, that they don't necessarily have a place to place that money. So this is why they have to take risks and they have to put it into like startup companies, which many of them failed anyway. But that's not the point. The point is they got to put the money out. And back in 2020, when many stocks, Sofi not necessarily included, but many other tech or EV stocks, the reason why they took off is because a lot of the capital left the blue chips companies. And they left those companies and they want to go to somewhere else. And they found this wonderful place called Tesla. That's, in my opinion, one of the main reasons why Tesla price was multiplied, I think, by 10 or maybe a bit more than that during that period of time. And I'm not sure that this kind of moment is going to necessarily repeat itself in 2022. I think that at least as far as the financial market is concerned, things are going back to normal. At least that's how I feel when I look at the financial chart or when I analyze like the financial flow. If the interest rates are going to increase this year, then yeah, we're looking at some increased risk for the growth type companies. Now, with all that being said, I'm still hopeful in some of those growth type companies, and Sofi is definitely one of them, because not every fintech company has a bank charter. Let's begin with that, right? Because it has a bank charter, or it's probably going to have one by the time the whole merger situation is over in terms of the regulatory side of things, then I think that this is going to be a catalyst, and that in the long term, we're going to see excellent returns from that company. So right now, the name of the game is you have to get in cheap And you have to get in at an allocation that won't hurt your portfolio in the long term, because you don't want to be forced to liquidate your positions at some point, right? You want to hold it for years before you're able to realize this potential gain. I would recommend a maximum exposure between 1 to 3% in SoFi. And if you have a regular risk appetite, I would say maybe keep it to 0.5% and to hold it for at least 6 to 8 weeks before consider selling it. Right now, it's better to wait for the support to be confirmed before entering. And I would say that they need to be present for at least a week before we consider to enter the stock. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon, because the financial sector would see its profit margins reduced, and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America, because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones, to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs, because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks being shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants, in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock, and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.